Welcome back, everyone. Welcome back to our weekly Friday visit together, a safe place for trend, actually non-trend as well. Anything, I guess. We never get into anything else but trading, which is probably a good idea. I hope everybody's doing well. And yes, okay, let me know if you want to be a speaker like Oleg. Please request to speak. I'll try to get you up here. And then try to keep your comments to about a minute or so. And then, so I don't have a lot to on my mind this morning. I saw a couple of good tweets. Articles this week. One of them was, oh yeah, this is kind of an interesting subject. I mean, I kind of like to think about this, about how one person said the odds are commodities will never be a sound long-term investment. And I think, as I said before, that's how people kind of look at futures or commodities or anything that's not stocks and bonds is, well, I'm going to put it in my portfolio only long only, and it doesn't seem to work very well. So I think that, of course, you got to add trend following to the commodities. They just don't go up over time necessarily. But of course, we want to add trend following to everything to make all the markets, stocks and bonds, even better as well.
Hi, Jerry. Hi, everyone. Hey, Jerry. I suspect your mic is flipping on your shirt. It happens to me sometimes. I suspect that's the reason why we can't hear you well. So to get it started, I'd like to propose a question here. We in this group we talk a lot about trend following and we increase our knowledge base on every week and that's great. But sometimes, I mean, most of the times I find it difficult to explain to people outside our trend following universe how trend following works. Why does it work? Why is it so good? And well, I come up with some explanations, some better than others. And this week's article by Mark was excellent on that answer. But I'd like to hear from you guys. Why do you think trend following works? How would you explain for a complete uninitiate why is it so good?
G'day, everyone. G'day, Jerry. Yes, I was finding a bit of a problem with the audio. I'm not sure what's happening there. But, yeah, that's a very good point, Bruno. And I love Mark's article. And I think the article this week, he talked about effectively the stickiness of prices. In other words, the markets don't factor in immediately price moves or the information related to price moves. There's sort of like a period of time, a lag effect where progressively more and more traders might come to that conclusion. And I think that's effectively what's driving these trends. It ultimately, to me at least, comes down to a behavioral trading impact associated with, I'm not denying that fundamentals do have a primary role to play in driving price, but I think price itself is the best mechanism to monitor because I don't think fundamentals are immediately absorbed into the market, especially with, these endogenous events where it takes a long time under uncertainty for people to come to a conclusion. What is the dominant driving factors of price? Jerry, how's your trading week been?
Can you hear me now?
Yeah, that's really good.
I don't think it's been that great. I'm still suffering a bit from grain markets and energy, but of course I've nailed it on the currencies, and I had some stocks on some short indices, and I guess it's mostly been currencies this week. I thought we were going to see some new lows or get closer to the lows in interest rates, but we didn't get there. I found it kind of interesting that there's just tremendous buying of the dip or something going on as it relates to these stocks. I mean, there's not a bit of bad news, 19% inflation, I believe, we'd have seen the Dow rally, the S&P rally, and go positive on the day. I don't think there's anything that's I can understand about these markets, and I don't need to, So I think what makes these markets move. I mean, I like that endogenous, exogenous ideas we talked about earlier. I think Eric likes to say it's about the hedgers. We make money from hedgers. I guess that's not why we have big trends, but I'm not sure if I can wrap my head around that. But the markets just for whatever reason have these outlier moves, and it's not a normal distribution. And that's what I've always thought, but I don't know why they have them or why why what we do has a tendency to work. But it doesn't keep me up at night. Yeah, that's Eric's second point. If I didn't know who or how I was making money or why I was making money, I don't think I could sleep at night. Well, I have no trouble not really fully understanding why the world is a crazy place and you have some outlier trends. 5 or 10% of the trades are pretty crazy, and that's what we have to target. So it's not something that I fully understand. I'm ready to embrace anything as if someone could make a compelling case. And the best thing I've heard is endogenous. I love that.
Actually, Mike, I think you're big on behavioral. What are your thoughts?
I think trends. I really like the behavioral driver of trends of being, or at least maybe in the stock market where markets underreact and overreact. I think trends. The reason that a price drifts from 10 to 15 over time is because because markets underreact to whatever information is driving it to start with. And then I also think that trends get to an extreme too. They'll move a little bit too far on either end, up or down, which we see. If that were not a true statement, by the way, you wouldn't see these 5% immediate reversals. But I think trends. I mean, now when it comes to commodities, they all have their own drivers of supply and demand. But when it comes to just generally thinking about trends and the reason that trends drift up over time, having watched charts for 25 years, I think a lot of it is just under reaction to information, and there's a lag in how long it takes for people to respond to whatever the driver of whatever the driver of the trend is. But I think too, there are probably, I've always thought that the trend following for commodities in futures markets was somehow connected to the hedging, because there has to be, it's a market there. You have people that want to hedge. Well, look at what I just said. I mean, overreaction. If the person that wants to hedge their bets, they need somebody else on the other side that has the opposite view. So they're going to want. So look at it in a simplistic way. Assume you're applying the relative strength index to a trend, and RSI is at 80 or 90. Okay. So if you're trading RSI with a counter trend, and you would think that 80 or 90 is extremely overbought, but not Jerry Parker. Jerry's going to buy that. He's going to get more excited as it gets more stretched to the upside or the downside, short it. And so, but the reality is most people are probably doing the opposite, because they're afraid of the reversal. So they're going to try to hedge off some of that risk that they perceive as being overbought or oversold. So I think the hedging has a lot to do with it too. The fact is, it's probably a lot of things, but ultimately it's all behavior.
That's true. I would buy that strength. But, in hindsight, when you have these trends or especially the big trends, it's pretty shocking. We get in at a good point. It's not like it's an outrageous price when something goes so far. Buying those breakouts, even though it's not near the low necessarily, it's not a bad place to get in. I have another good quote of Eric's is that he told me once that, these breakouts, upside breakouts, for instance, they are, that's where the market's undervalued because, when it goes 50, 100 ATRs, it certainly was undervalued. So I don't get too hung up on where we buy and buy in the highs. I'll bet you if you did a study, um, where people buy in these markets, if you're not going to wait for a trend to develop, then you're going to try to guess and buy on the way down. I'll bet you if you looked at our entry prices and their entry prices, it wouldn't be too far off because they're guessing and we're trading with an edge.
Well, since trend, if you think about the whole trend following is going to, you really truly are especially when you're trading 100 markets, or a whole lot of markets like Jerry is, you're really looking for those outlier trades up or down, along the ones up, short to ones down, and those outliers. When I think of it, I visualize just looking at a simple chart of a trend and RSI, the relative strength index, applied to that trend. And you just think about what the outliers are. Well, the outliers are actually defined by the relative strength over, say, a 14-day period being really, really high, really, really low. So the thing is, those outliers are captured by extreme momentum. And, pure classical trend following is going to want to get in the direction of that trend. And even though I know that those trends are going to probably more likely may not continue. However, and that's where the 40% win rate comes in. More likely, you may not get into some big, long, prolonged trend because it's overbought, because you're buying a breakout that's really overbought, in the short run. However, the really big killer trends, like we saw in oil, 6 months ago, those really killer trends are going, they are going to be that really super overbought RSI kind of trend, and that very, that's the very thing that you're really looking for, is those outliers. And because you're not afraid to be wrong 60 or 70% of the time and take a relatively small loss, what you're really trying to do is you're trying to catch the big move, which, say, in energy, was 100% move over the past 12 months. And so that there's where I think the hedging part comes in, because the 60 or 70% of, look at it this way, 60 or 70% of the people that are trading that market are thinking, well, it's really overbought. I like the trend, but it's really overbought. So there's your market. There's the other side of the trade. And or people that are dealing with energy because they buy diesel fuel or whatever it is they do, and they want to hedge off that risk. They need somebody that will step in and take that position on, when they're wanting to hedge off. So, yeah, it's all, I think it's interesting to kind of understand market dynamics the best we can, because I don't think we can fully understand it all, because there's millions and millions of people trading in these markets and driving it. But ultimately, there are some overall conceptual things, I think, that drive the trends. But I think what I just said is kind of a useful, because I've always been a trend follower, momentum. I've always, following the trend and staying with the momentum is my favorite thing to do. But, there are those maybe 5% of the time where, I start to myself even realize that, this trend may reverse, and probabilistically it probably is, and that's where I think that's where your win rate gets reduced with trend following, is because you're not trying to have a 70, 80, 90% win rate with small profits. you're looking for the really big runs, and to get those really big runs, you're going to be taking positions in a lot of things a lot of times, and you're going to be taking positions that are extreme, a little more extreme. They're breaking out, so they're over a short period of time, say every 30-day window, you're wanting things that are going outside that normal band, that normal true range of price.
Hi to everyone. I had some program issues today, but now I think it looks more perfect and I can hear everyone. I want to say here that when we are talking in such a way that we are not afraid of being wrong, it sounds like we are not afraid of doing mistakes, but here I think we are not. It's not very correct spelling of this, because in fact, we can be wrong as systematic traders. We can be wrong in a systematic way. But of course, here, when we have trades in our stop is working, I mean that we have trades that is not performing well. We are not wrong. It's a part of our game, and so I don't think that we don't lose much, and we are not wrong in a general way, in a systematic way. And if a person has a discretionary trading, he is maybe really in a very bad situation. He is right in more situations than he is wrong, but when he is wrong, he loses a lot. So I think that it's better to be right in a systematic way, not on a particular trade.
I wanted to get your opinion on this. Adding a material amount of single stocks to a CTA trend following strategy allows allocators to reduce their allocation to long-only buy and hold stocks. I mean, you see, that's so obvious to all of us, but it's not anything anyone would ever do. They're not going to say, oh, you trade single stocks, 30% of your portfolio is stocks, but you're just trend following them. Well, I can give you an allocation and take it away from my stock only people, because you're trading stocks as well, and you'll do well if stocks go up and down, of course. And so I just thought that was kind of funny, because 23 people liked it, but there's no one on this planet, no allocator, is going to look at it that way. They're going to say, I have my stocks and I have my bonds. Maybe I'll allocate 5 or 10% to trend following that could help me when the stocks and bonds do poorly. So I just thought, in another world, in another universe that I ran, everyone would just be allocating to trend following and saying, I've got plenty of stocks, and but they're all trend followed, because that's the safest way to do it. And then, frankly, when I set up my portfolio with 20 or 30% allocated to equities, I'm going to probably approach 60 or 70% of my assets. If there's a big uptrend, I might be long 60 or 70% of my of the value of my fund in stocks, because of the leverage factor, because I have to leverage them up a bit, and I'm taking small losses as well. So it's going to be quite a big allocation to stocks if they're all in gear, if they're all trending upwards. But of course, that's not going to happen in this environment. We need to see another major sell-off in stocks before people sort of see the benefits of stocks plus the trend following.
And I'm sure that if we allocate to an asset class, it must be a meaningful allocation.
Oh, hi, Jerry. I'm Lucas. I'm the university guy. I was in Washington. We had the meeting previously. Nice to meet you again and see you here. Really appreciate the content and really great things out of talk here. I had a question on backtesting. How can we make multiple backtests? What are some ideas that we can start generating, such as, I don't know, some range breakout from 150 days, 200 days, and closing with the crossover, things like that. What are some like starting things and ideas that we could be backtesting in order to build our trend following system?
Well, as you know, I like the breakouts, and so I've just an alternating breakout, long, flat system with an ATR stop loss. So it's pretty simple, pretty easy to program that. I used to, back in the 80s, we used TradeStation before we hired programmers and got more sophisticated. But yeah, I like the breakout approach. I suppose moving average crossovers are what people use as well. But yeah, 100-day high, get out at the 75-day low, and use a ATR stop loss, 4 ATRs, whatever. So start there, and then just plug in, the variables and test everything in 25-day variables or 10-day increments or whatever. So it's nothing very difficult. And like I said, I like to look at charts and see what it looks like, keeps me in those long-term trends. I wouldn't go shorter term than 100-day breakouts, though. I mean, that's just me personally. I know that some people do, and that's worked a lot better the past couple of months. Long-term has struggled. I've struggled the past month or so.
And I want to say that when I started to trade and to have even few years, maybe 5, 6, 7, 8 years of experience in trading, I thought that it's okay for me, it's acceptable to me to have something that is very complex, that is very hard to do, to execute. But I will do it. I will trade from morning to night, and if it needed. But when I started to learn from Jerry and Niels, I understand that I don't need this. I need simple. It works better. Simple strategies, long-term strategies works better. And I really tested all this, and I saw this. It was brilliant when I understood this. I thought about that it may be so, but I did not know that exactly. And I thought that maybe some fundamental things, global macro, I think maybe it's the next level. And I understood that it's not, I don't understand how to apply it in a good way. I did not understand this, and I was very happy to understand that I don't need this. So when I'm doing my back test, one of the questions is, do I really need this? Do I really need this filter? I don't use filter now, but do I really need this filter? Do I really need this approach, first of all? And I understand that I really need classical trend following approach. I really need this, but nothing else.
Oleg touches on a really important point here. The thing is, when you start thinking on backtests, on new systems, on new ideas to approach markets, you run in a huge risk of overfitting your system, because you see market behavior in one behavioring in one way, and then you try to think of a system that can tackle the market on that situation. But then time passes, and then market behaves differently, and then you try to think of a new system, and that's why you run into serious risk of overfitting, because the market behavior rarely repeats itself. That's the reason why we are so fond of our simple systems, because they will be able to make profits of markets that never happened before. We are aiming for that 5% outlier, that 5% of trades, of market moves that have never happened before, and that will impress everyone. But if it has never happened before, how can you think of a system that will perfectly tackle that price move? Well, you can't. What you can do is think of a system that can survive on most of market situations and thrive on that 5% outliers.
I like, Bruno, your point, and by the way, now I understand, and I have said this before many times, when I have a maybe traded idea or something like that, I think that first of all, I have told this, must understand the logic behind this, and as you said, where is the logic, and does it have an ability to act in a such way for a long time? So, of course, we can use a lot of different parameters, filters, and so on and so forth. And usually, and as I remember, my previous experiments in backtesting experiences and experiments, that I saw that, this year, in a current situation, my system is not working very good, but if I will do some changes, it would look perfect, and I would had another performance, very good performance. I'm talking about a few years ago. I was a short-term trader, and I'm talking about that experience. But when I did a massive backtest, I saw that my new ideas are not perfect also, and my new ideas will show the same drawdown, and in the very best situation, it will be the same. So here's my point.
Okay, I wanted to comment on Bruno. That's a very good point he made, and I think this is why I think that I was taught, and I kind of continue to say how important sample size is, because you have these outliers, and they make all of your money, and that's why we can't separate them from the other trades. We're not dividing up the trades based upon their profit or the max profit. We're just counting the trades that fit in our one entry, one exit stop loss system. And that's why it's so important to have a lot of trades to look at in the past and not have too many parameters and variables that are going to reduce that sample size, because we want to be able to say we have 5,000 trades that were handled in a certain way, the same way, and oh yeah, some of them were 50 to 500 ATR profits, but we don't want to have to segregate those based upon their profit, because it will only be 5%. And as we've said before, there is a Bill Eckhart article out there that says you have to have a lot more sample size when you have a distribution like the one we have, which is one that's dominated by so few trades. So there's nothing more important in your back testing than legitimately counting your sample size of the trades. And so we count the trades, entry, exit, entry, stop loss, and then a lot of people, though, most people, they don't count the trades. They analyze the daily returns or some sort of period return. So that's just not how I was taught how to do it. And I'm okay with not changing. I mean, I would change, but I need to have evidence on changing. I don't know if you noticed this, but I had fun with, on my Twitter bio, we've been getting a lot of criticism and a lot of people not appreciating our philosophy of no vol management. So they've been kind of putting out these kind of statements to make fun of, me primarily. And so I've included a lot of them in my Twitter bio, that right underneath my picture, where I describe myself, Chesapeake, trend following plus nothing, hunting outliers. And then here's the first one I put up there. And other ideologically pure, meaningless labels. Ideologically pure, meaningless labels. And then this week I found another one that somebody had said about Moritz and me, and that is that we have tinker toy hobby level systems. I don't know if you know what tinker toys are, but I think they were a thing back when I was a kid. I think it's like building blocks to a degree. Tinker toy, hobby level systems. So these things make me laugh. There's just not enough room up there in that bio for me to include them all. I had to take out some things that I really liked, but I'll be switching it out. So if you ever see people making fun of us or me, let me know, because I don't think I see them all, and they're pretty funny. So anyways, you got to have a sense of humor and not be so darn nasty.
Hi, I want to say that about sample size, and I have said this before, but it's important for me because it's my experience that if you're in a short-term space, if you backtest a short-term system, you can see that maybe in a year you can have 10,000 trades, 20,000 trades, and so on. But we are talking here about the same environment, about the same regime. And so we can see, for example, short-term system with a 10,000 trades sample size works perfect in the same regime, but the next year it will be another regime, another environment. It will not work. This will not work, and regardless, we have that big sample size. So our sample size must be in different environments. I'm sure it's so because it's my experience of backtesting.
Hello. Hi, Jerry, and everyone else. Thanks for setting up this environment. It's really, really unique, actually. In terms of the first topics that we've discussed, saying that why it is difficult to explain trend following to everyone else or every sort of investor, I was just thinking: is there any website or anywhere else in the internet, on the web, where we can see how much of the assets under management is being allocated to trend following strategies? So that would be my first question. That would be great if there is a link that I can actually track year on year how much, what is the exposure to trend following funds and what is the exposure to the rest of the funds. That would be my first question. The second one is this week Niels has sent the Dun Capital returns for the first 6 months, which was around 50% CAGR. And then another email subscription that I've got has sent the Malvern Capital 6 months CAGR, which is around 100% for the first 6 months. And is it possible to comment on how these huge returns were possible, specifically where many of us are doing much more humble, even though this is a great year? I would just love to understand what is that secret sauce that make the Malvern Capital around 100% in the first 6 months. Is it just leverage or is it something else? Thank you.
That's a good question. I mean, I'd like for Rich to chime in on this. Rich keeps up with the performance of trend followers, and I read what he puts out there, so it's readily available. I think Mulvaney trades enough markets. He trades a diversified portfolio. He uses a lot of leverage. I don't think he would use any volatility management or profit taking, profit objectives. He's probably medium to long term. So as long as the markets keep going up, he's going to do pretty well. Like me, like all of us who, as they keep going up, we do great. The rub is that when they turn around, the medium to long term has a tendency to give back some of the profits. And without the vol management, the markets can reverse a lot quicker than they go up. So the vol management, I think, has worked really well here in this period because the markets were highly, the ATRs had expanded and you were able to take profits on the way up, probably, or shortly after they turned around. And now if they reverse and go back up again, the medium to long-term no vol management will do really well. If they keep going down, we'll continue to underperform. So it'll be interesting to see. I don't have Mulvaney's performance intra-month, but I think that he is very dependable, that he always follows his system, and he does have big swings up and down, bigger than most people. And so he's like one of my heroes. I think he's totally a stud in that he follows his system regardless of the P&L swings. What say you, Rich?
Yes, look, you can, Nielsen Hedge provides a database of CTAs. So within that database, you can find the assets under management for different styles of program. So it's much broader than trend following. It also includes a lot of different other trading methods. But the database is wonderful for you to be able to isolate out different classifications of system trading and look at the levels of AUM in the CTA space. But aside from that, you'd probably need to use things like Barclay Hedge or other databases that capture broader performance. But Nielsen Hedge certainly is a good one. But look, in relation to Paul Mulvaney's fund, I think that he goes where I'm afraid to tread. In other words, he does trade with higher volatility. He is an absolute stud. I totally agree with Jerry. He has no fear, and his returns, basically tell the story of a classic trend follower with no hole, with good leverage that can absolutely hit the ball out of the park during particular favourable regimes. But he does cop the volatility when regimes become unfavourable, but it certainly is an impressive track record. And so he's basically got, I think, 100% return for the first 7 months, close to that so far. It's a perfect environment for trends. I'm finding that the environment this year is the best I've ever experienced. I've had a very short track record, but I know Jerry's commented on the favourable trending environment, but what's really interesting to me, at least this year, is that we're not getting the classic retracements from high watermark. So this particular month, this first 17 days or so of this month, I did get slam dunked with the energies, but my currencies were able to sort of keep me at that high watermark level. So I didn't get that classic whip, downturn that we get after a period of successive great returns. And I think that might be associated with the fact that we are definitely in a uncertain regime that's really beneficial for trend following.
And I think that, in fact, there is no maybe such thing as a certain regime. Yes, we have periods that look certain, but we don't know the future, and we don't know what the tomorrow day will bring us, or maybe in a few hours what will be. And so, of course, we can see periods for 10, 15 years, 20 years, theoretically, that look certain, stability, and certainly, but I don't think that there is such thing as an absolute certainty in all this.
What I like at the moment is a conflicting narrative about inflation. We've basically got two extremes of narrative. Now, I think that's great for trend following because it places this degree of uncertainty in the air, which I think is fantastic for trends. What do you guys think?
Yeah, I agree. We had some people calling for $380 oil and some 65, and we have some people saying that inflation has peaked, and we keep getting the higher numbers. So it's a good example of even though we want to ignore the fundamentals, it's a good example of how can trends, how could that trend of years ago continued? Why didn't everyone see what was happening? And they do continue, and there is this conflicting opinion, and people just get wrapped up in their opinions, and sometimes they'll be right, and sometimes they'll be wrong, and we just have no opinion. So that it makes us look silly when the market turns around, and we don't get out and take our profits, but our contention is we don't know that it's going to turn around and go the opposite way, because a lot of times these markets, they turn around only to go back to new highs or new lows. So it is very interesting, these dealing with these fundamentals and listening every day. Stocks go down, but if they go down too hard, then they go down because of inflation, because rates have to go up. But if they go down too hard, rates will rally for the flight to quality. So it's really interesting how we're faced with, in the Fed. Who believes the Fed? I just have they have no credibility, and I don't trust what they say, only what they do. So maybe it's a very fun time to be trading.
And I think I fully agree with this, and I liked this approach that, for example, maybe it's not a very good example because I'm not an expert in global macro, but maybe two weeks ago I thought that my fundamental view was that gold and silver will go up because of crisis environment. But in silver, I don't trade gold, only silver, because of its price, because it's more cheap. And I had a signal, down signal. I mean that I short signal, and I started to trade short, and now have a profit, small profit. But if I used my fundamental view, I would not have this short position on silver, because in crisis environment I believe that silver and gold and platinum tend to go up, but I don't see it now. I see that it goes down. Maybe, of course, it's too early to say something, but I'm absolutely sure that this trend following unpredictable approach is the best way we can do.
So tomorrow is one of my favorite days of the month, and that is when Rich shows up on Top Traders Unplugged. And so looking forward to that. And I enjoyed Alan's as well last week, but I'm looking forward to learning a lot when it comes out Sunday or Monday. So can you give us a preview, Rich, on what's on your mind this weekend with Niels?
Yeah, look, I'm thinking of talking more about some of the things we've talked about on this Spaces is the issues surrounding trend following indexes, and I think the points that have been raised by Moritz and yourself, etc., and the others are really wonderful. So that'll be featured hopefully in the podcast with Niels, and also looking at system ensembles. In targeting these outliers, I'll be talking about the benefits of using a diversified suite of trend following systems. They're the two things on my mind. There's another point I've forgotten, but I think Niels is here. He might be able to discuss what his plans are for tomorrow.
Niels is not going to like me trying to get a preview of his show, so.
Good. Hey, everyone. I think the topics you mentioned, will definitely go through those. There was one other thing that just came up this morning. I saw, I was referred to a video on YouTube where a volatility guy was discussing, and I tweeted about it, a couple of clips from the conversation where he basically said, listen, CTAs did well as a quote-unquote hedge so far this year, unlike volatility, despite the fact that equities are down 20%. But his view was that, going forward, it's going to be the reverse because commodities are not doing well. So you won't expect CTAs to do well. And volatility hopefully will be picked up, So I think that's an interesting topic, because I really don't see ourselves, I've never seen ourselves as a hedge, first of all, because we're non-correlated, so you don't know how we're going to react to any market regime or move, really. And I think it is interesting to note that a lot of investors moved into long volatility strategies or volatility in general because they wanted protection, and so they completely missed out on the protection that we provided. So I just think it's an interesting topic and debate. That I think some investors, unfortunately, still believe that volatility will always go up when equities go down, but clearly this year has proven that that's not the case. Likewise, CTAs, as you said, Rich, CTAs haven't really lost a lot of money despite a lot of the commodities selling off hard in the last month or so, because what's happening right now is that the markets are divergent, meaning they move independently of each other, and that is something that is not, I think, appreciated enough by um, investors. That trend followers, have their best times when markets move, but they are also divergent at the same time. And that's what we're seeing right now. And I think that's what makes it super exciting. So those are some things that just spring to mind when you raise the question, Rich and Jerry.
Yeah, that does remind me of a tweet from someone who put out a few weeks ago saying, doesn't it feel like the CTAs have the same trade on with their long commodities, short bonds, and long dollar, which it could feel like it, I suppose. But, these markets, they can all move together, or you can get a fair amount of good diversification. It's just something that's hard to predict. And it's the reason we're encouraged, the back test encourages us to trade as many markets as possible. So I think, yeah, that's a really good point. Thanks, Niels.
Hey, Niels, I'll add to that if those people talking about the commodity trends, thinking that they're at a peak or whatever, if those same people knew that in advance as they purport to do, then they would have certainly gotten out of the stock market and the bond market before it dropped 20%, huh? The thing is, people who pretend that they know what the next trend's going to be, they wouldn't need any. We would all put their money with them. They wouldn't need any of us if they knew in advance that some trend was going to end. Because J.P. Morgan, I know, for example, Marco, they've been calling for a commodity uptrend super cycle. So who knows? Maybe J.P. Morgan's right, and there's a massive uptrend in inflation super cycle for oil and other commodities. But yeah, I mean, it's funny that I've been chiming in, listening to a couple of these other Twitter spaces from a broad range of people, and the fascinating thing, it's really fascinating how different this group is than all the rest. In that, here we're talking about just trends and capturing the trend, not worrying about what direction it's going to go. We're trying to figure that out, and all the others, everybody's trying to figure out what's going to happen next, and trying to figure out what to do next. And they're sitting around, and we're talking money managers here, not just individuals. They're sitting around trying to figure out what to do, sitting around trying to figure out what's going to happen next. They're sitting around looking at, trying to figure out what the inflation and what the Fed's going to do, and all these things that are just impossible. There's so many variables in the global macro that it's just, looking at global macro, sure, you're going to see that some things are probably more likely than others to trend or whatever. But, most people right now are struggling because they're down 20, 30%. If they were, in the wrong stocks, they could be down a lot more than that. Even long-term treasuries down over 20%. I mean, but yeah, while most people are getting on these Twitter spaces talking about, macroeconomic factors, and they'll spend an hour talking about one little topic on it that probably will have nothing to do with the next 6 to 12, months, but they think it will. So they'll sit and talk about it and give their opinions and share their opinions. And, but anyway, it's funny that, if the people that are calling for trend following to not do as well going forward, I mean, if they knew that, they certainly could have they could have exploited it better. So.
Hey, Mike. Oleg, if I can just reply to Mike on this one, but I think the point that I'm kind of that I really want to make here, Mike, is that it's so interesting to me that even a guy like this, who's a famous guy, I think, and who runs a volatility strategy, but to me, it's more the fact that they have so much certainty. They talk about that they know what will happen, and that's what surprises me, because we have so much evidence that we can't predict really what's gonna how things are gonna pan out. Even if we know some of the things that might happen, we still don't know how markets react. And for all I know, I mean, all these calls about a commodity supercycle, I think they could be right, but people forget that markets don't go up in a straight line. And even if oil trades down from $130 to 90, it's a fairly small correction, about a third, given the fact it came from minus $37 and went to 131st. So it's just fascinating to me to watch the fact that people are so certain that they know how markets going to react, because what evidence are they using for that?
And I want to say that if a person knows future, if he thinks that he knows future, certainly, he don't need any system at all, any system, because he can go to a casino, he can go to sports, bets on a sport, on something like this. And I think, or maybe to predict future to the people and make money from that. Maybe it's a joke, but it's not a joke even. I want to say that they say that we have a probability. We have a probability of what will happen, and we trade according to this probability. And I want to say to this that what benefit does this probability give to all of us? And in fact, in the very best situation, this probability will not give any benefit. Yes, I don't understand even how to count this probability. I mean that some people say it's 80%, then stocks will go up 80%, but how? Why 80? I think a 50% that stock will go up and a 50% that stocks will go down. So stocks or will go up or will go down. We have only this probability. And when we apply rules for this probability, we have benefits from it. Systematic rules.
Yeah, that's interesting, because at least for a lot of people, for the non-vol management people, we're going to make money on 5% of our trades. They're going to make all of our money, and it's going to be these monster outliers. And so being able to predict the monster outliers, the Tesla and Moderna out of all the stocks, or the yen and what else? The yen, I guess, in the currencies. And, this is kind of hard to do. Sure, when sectors move, like the interest rates and the currencies and the commodities, we tend to do pretty well. But at the end of the day, at least for me, it's going to be primarily just a few of those markets are going to make most of the profit. I'm not scoffing at the sector profits, if you want to call it that, but I'm going to do better when one of the sector has a big move, a lot larger than the rest.
And I think that prediction, as I have said now, that prediction the markets is the same thing than prediction anything in this world, in any space. So I don't see any difference.
Well, here's where, and Jerry and I have talked many, many times about prediction and things like that. And and I've got pretty wide range of my thoughts on the prediction. I don't think we know what's going to happen next. And I said, I was the fourth interview that Covell did on this trend following radio back in 2012. And of course, now he's done well over 1,000. And something I really focused on was talking about, we just simply don't know what's going to happen next. We may know the probability, but here's the way I see it. With what we're calling trend following, trend following to me is probably, I don't know, that's more the signal. I think a lot of people are saying they trend follow, but they're not position sizing. They're not putting in a stop loss. They're just adding a moving average to, say, the S&P index or something. They call that trend following, and it is, but it's just that is the Tinker Toy version, by the way, Jerry. But if that's all you do is apply a moving average to SPX, and yeah, that I think we could probably call that a Tinker Toy. But thing is, what most people are doing is they never get past. I think of asymmetry, and what I call asymmetry is what, say, Van Tharp called expectancy. And Van Tharp probably popularized expectancy, which came from, I think, Richard Dennis and the Turtles. But expectancy is, the mathematical expectation, expected value, whatever you want to call it, they're all the same. Where what we're looking at is the complete system, the entry, the exit, the size. And we're also looking at not just the probability of winning versus losing. We're also looking at the payoff of how much you win when you win, how much you lose when you lose. And, that's probably one of, even George Soros talked about that for, decades ago, that the most important thing is how much you win when you win, how much you lose when you lose. And that was a hint that he's talking about expected value. They just didn't come out and say it. I think expectation is probably the single biggest secret to portfolio management that most people don't do. And what most of the market participants are out here doing is they're trying to focus on improving their probability of buying a stock or commodity, whatever, that goes up or down, or short the ones that are going down. And whereas we're more focused on, the full complete expectation, the full asymmetry. To generate asymmetric returns, you're focused on how much you win when you win, how much you lose when you lose. And the net of that is your expectation over time. And the more trades that you apply it to, then the more in line with your expectation it's going to become. And in short runs, you're going to have a lot of periods where, it's going to stray from your normal expectation. And that's all something that you completely are in tune with. But to me, it's, I was going to publish a book over 10 years ago, and I've still may do it one day. But one of the biggest concepts I was going to focus on is really that complete equation, and not just, most everybody just seem more amateurish in that they're, so think about this. My mind thinks about what entry, exit, and size system can I apply to this market or all these markets that's going to generate higher average wins and higher than average loss. So it's probability of how often did it enter and exit. And by the way, it's enter and exit. How often it enter and exit position, and how much was the gain, and how often was it wrong when it entered and exit. And it ended up being a loss, and the summation of that is the essence of portfolio management. And that's what, I started calling, for me, I call that asymmetry. And what most people are doing is they're sitting and looking at, just simplistically think of, the S&P 500, and they're looking at the S&P and saying, well, should I be in it or not? It's just a binary decision for them. And so they're just focused on the probability part, the percent win versus percent loss. And they're trying to increase their probability of being correct. And they think, by doing a lot of research, they can better time the market that way. And they never get past. I was there 20 plus years ago. That's what I was thinking, before I discovered the essence of portfolio management. I did the same thing. We all did. Most everybody sits and looks and tries to figure out, what's the next direction most likely to be. And so, so my point is that a majority of market participants are probably operating in an incomplete system where they're never getting past the trying to be right part of it. And whereas, you can tell when Jerry's thinking of all these different markets and applying systems to them, he's not really so much thinking about, what's oil by itself going to do, or, just 1 or 2, 3 markets, trying to, see what the trend is there. You're really focused on what is the output of applying this entry, exit, and size system across all these different markets. And, so that's where I think it kind of comes in, is I think it's a function of what we're calling trend following here is really not just trend following. Trend following is getting in a trend, and technical analysis books for 30-something, 40 years have been saying, your objective is to get in a trend early in its stage and capitalize on that trend till it ends. Well, that's just a trend following signal. The true trend following, what we're talking about, goes far beyond that simple signal and gets more into, how do you determine when to sell a loser? How do you determine when to sell a laggard? How do you determine when to sell a winner? And then and based on those things, how you determine how much position you're going to have. So, that's, to me, it just kind of comes down to a complete system versus somebody who's just trying to time the market.
I agree with all of that. I agree with that. It's really, as much as we love trend following, it's really that we're systematic traders primarily, and we follow rules, and we did a back test, and we happen to stumble across a methodology that's trend, but we're systematic first and foremost, and trend is a part of that. But it always, you can sort of tell when people ask, like, well, has the trend ended, or what do you think about this trend? And you're like, well, I don't really have a clue as to how this trend is going to play out, or has it ended, or even has it started? Is it a real trend? How far is it going to go? It's really an application of these rules over all the trades for the rest of your life. And how is that going to play out over all of the trades? And it's a game, and it's betting. It's not what's going on now. We're certainly, trend following has no ability to optimally handle the current set of trades. I think that's the problem that makes it so frustrating to like. I need to know now what I should do with these open profits or with these particular markets, but it really is, no, at the end of the day, after a 20, 30, 50-year career, this is your best way. This will put you in a high likelihood of making a decent amount of money and maximizing your opportunities and potential.
I was just quickly going to say, I think in general, people don't like to lose anyway. So a strategy like trend following, where the win ratio is so low, especially what Mike was saying as well. People focus on the how many times do you win. So it's very hard to then shift that way to, okay, I'm losing so many times, but when I win, I gain more than I lose. That kind of like the risk reward type of mindset. It's very hard for people to grasp that, and even if they grasp that, I think our inner self is very hard to latch onto that, because just in general, people don't like to lose. So I think it's a good point that maybe people are so focused on that, that win versus loss, that they keep shifting away from that. How much do you gain when you win, and how much do you lose? And that's just really prohibitive.
And I want to say, people like predictions very much, even if they maybe understand that it's not truth, but people like somebody to tell them something about the future which looks logic. For example, my father has his savings in United States dollars, and I think it's right decision. But he asked me in spring that what do I think about the future of Russian ruble against United States dollars, and I said I have no idea. I have seen that it's a long-term, 30 years long-term downtrend in Russian ruble. That Russian rubles goes only down, but in fact, I don't know the future. And he said that I watched a lot of experts on YouTube, and most of them, 90% of them, says that after 20 of April, Russian ruble will fail down very much. And I said, I have no idea. And maybe in May, I said to him, and what do you see now? And he said, Russian rubles is not failing. And I said, but today is May, not 20th of April. And I want to say that experts, they only attract attention of a people by their predictions, attract attention to themselves, attract attention to their funds, and so on. So, as I have said, that even if we have a probability of event, it means nothing for our trading, for our investment. It really means nothing.
Okay, now's the time for someone to ask some questions. If you want to be a speaker, let me know, or you can send me a direct message. What's on your mind, what questions or what comments you want to make?
And by the way, Niels, Dunn is having an incredible year too. So let's not forget that. I mean, of course, Jerry is all these big positive returns in a year like this. I mean, obviously this is where following the direction of trends pays off.
Yeah, indeed, Mike.
Hey guys, I wanted to ask a more philosophical question. Like every week I come here to listen to you experienced traders talk about all that you have learned during the years and decades, and you always tell about trend following and trading so well, like you know everything, like to diversify and what's the difference between trend following, like actual trend following, and what others see, like Mike was describing, being right, trying to be right. So I have this philosophical question that what are you experienced traders struggling with most nowadays in your own trading or with your own self-development or development in trading, that maybe like in 10 years you're gonna say that, oh wow, in 2022 I learned something. Is there at all anything that you struggle with or that you are still learning? I mean, you, Jerry, Mike, Richard, Niels, all you more experienced traders who have been doing it for decades, and it seems like you already know everything.
Well, I think one that I'll point out, since Jerry's the host, is knowing Jerry for a long time and communicating with him regularly all these years. I think that when back when, before we started having these, a more prolonged downtrend in the stock and bond markets, I noticed, I know that I could tell that Jerry was feeling the pressure of adding more stocks, and all along, I was thinking that when you start to feel that pressure, that the stock market was going up so well and so easily for a prolonged period, really the stock market, a fundamental CFA valuation oriented person would perceive, and I say this because I know people who were those people, would see the U.S. stock market as overvalued starting around 2013 when it hit 20 times earnings on the Shiller PE, and of course then it's gone on to go, it's trended all the way up to 35, almost 40 times the last 6 or 7, 8 years. So the stock market has received a windfall from the Fed put, and so stocks were, even after they dip. I mean, look at 2020. I mean, notice that nobody's talking about March 2020 as much as we probably should, because I mean, I'll tell you now, March 2020 was a waterfall decline worse than anything I've really seen. You're talking, 35% drop in 3 weeks. Okay, so that was a real crash. However, the only reason people aren't talking about it and researching it like we did 2007, 2008, 2009 is because it was such a sharp fall after a major global event, a crisis, and it's almost like people just sort of let it go because, but it's really because really of two things. Number one, it was very sharp, but it rebounded very quickly. It was a V, and so if you did just hold on, in the stock market or whatever, you didn't have anything to worry about. Just a few months later, it recovered. And the other, so it's really two parts: how quickly it reversed back up and how short-lived it was. And whereas this time, you go on Twitter and the sentiment, I'm on Twitter primarily for sentiment, and I enjoy, trying to help other people. When I see people kind of going astray, if I can, I've done that for over 2 decades, trying to, we used to do message boards 20 years ago, and where, a group of us would go in there and kind of, somebody would be having an issue and they'd post it, and a lot of us go in there and try to help them resolve the issue, whatever it may be.
I try to help you when you go astray.
Yeah. Well, the thing is, Jerry, I always told Jerry, you need to stick with, you just stick with what you're doing, because this will all pass eventually. The stock market is not going to, it's just not sustainable. The stock market is really an economic factor, and that big uptrend is not as sustainable. And, so I think that obviously what Jerry is doing has worked for decades, and it's always going to have periods. Everything we do is going to have its periods. I mean, I'm running 33 systems live, and these 33 systems are not, they're trend. There are different time frames of trend. Their momentum, which is a little different than trend, and say breakouts. Trend, to me, pure trend is what Jerry's talking about. Breakouts. Most discretionary traders that are trading stocks, by the way, are they're trading trend, and that they're trading breakouts. Stan Weinstein, has the 4 phases and the big base breakouts. William O'Neill, the cup with handle patterns, all that pattern recognition they do, all of that is big. It's base breakouts. So stocks tend to move up, and then kind of they may trend sideways for weeks or months, and then all of a sudden they break out to the upside or the downside. When it breaks out of that base, that indecision is no longer intact. So that symmetry between supply and demand that created that sort of little tight zigzag line for weeks or months, all of a sudden something comes in and makes that trend asymmetrical, in that it either gets a whole lot more buying demand or more selling demand, and it breaks it into one direction or the other. That's I literally visually see that when I say it. I draw it on a dry erase board, and that's how I develop my systems. What I'm saying is I would literally draw this stuff out on a dry erase board, and then sit down and think about it again later. But I think that, the CTA trend following felt the pressure of the stocks, because other markets were being chopped up. Well, the reality is trend following applied to stocks over the last 5, 6, 7 years has kind of endured the same thing too, because the trends haven't been quite as prolonged. So when the Fed is providing an abnormal liquidity to the markets and capital markets, it really skews things. And that's what we've had. And now we're probably in the early stage we are in the early stage of unwinding that. So the Fed's now got to do something different because they've created this massive inflation. And so I think that's probably one of the biggest that I've observed, is just the, it's like, Covell really popularized trend following with his incredible books and podcasts and all the work that he's done to, put it out there. And now there's, there's thousands of people out there that consider themselves trend followers. I mean, there's individuals that have day jobs that are, trying to do what Jerry's doing, and I think that, that's what I think is probably the biggest one is when I could sense the tone of voice of certain CTA trend followers. You could see the pressure that they were feeling because the stock market's going up so easily, and they're getting chopped up. But that's all part of it. I mean, Jerry's got a perspective, longer than mine, because he's been doing this a lot longer than I have, at least 15 years probably, or 20. So when you have that, and also he's had the success that he's had, which I've personally seen. So I think you got to stick with your system when you're doing something that is right and you believe in it. You stick with it, and if everybody else wants to vol manage and do whatever else they do too, that's whatever. But I think that's been probably one of the biggest things in trend following, is that we went through this 5, 6, 7 year period of time where it really hasn't been as robust. But what blows my mind is how undisciplined people are to think that that they'd have to change that somehow. I mean, when you just had it, 2015, 2016, for example. As a matter of fact, Jerry and I were with each other during one of those flash crashes during, I don't remember, it was 15, I think it was 16. And I remember that morning, Jerry, you probably remember one day when the market had dropped a lot, and a group of us were somewhere, and those were real choppy, rough conditions. So it didn't matter if you're applying trend following to big indexes like the SPX, or sector indexes, or ETFs, or individual stocks, or whatever, or commodities. Those are just hostile periods. I mean, I've got in my disclosures that our systems sometimes endure hostile periods where they don't really they're not as robust, and I think that's just part of it. And now I think that it's almost always going to be the case that right about the time when you think you ought to be adding more stocks or whatever is probably almost certain to be the time, especially if you're a trend following mindset, because you're wanting to, trend following mindset wants to chase that past performance. We're literally doing that. But when you look at, if you start looking at performance past about 12 months, I think you start getting too long term, and the stock market tends to reverse every 3, 4, 5 years. It has cycles that way in normal conditions when the Fed's not overstepping, doing what it was doing. But, so if you start getting into wanting to get more stocks, and you're looking back 4, 5, 6 years of the trend, and your, momentum studies show that trend's more likely to actually reverse for a while. But, I think, having a robust system that's designed across lots of markets and different conditions, and sticking with it is the key. So maybe Jerry can add something to the pressure. I know that a lot of them were feeling the pressure of wanting to add more stocks during that period of time. And now here we are, looking no longer the case. And one more thing I'll add that I started to say earlier is when the S&P is down 23% this year, it's amazing how it's only down 23%, which is not huge. And I'm certainly not participating in that myself, but it's not a huge decline. But the key is it's lasted 6 or 7 months, and that's what's got people's attention. So it's amazing how the market is so bearish. The sentiment is so negative right now, and it's because it has, it's gone down and it's stayed down. And which, by the way, historically speaking, in my studies, which I've studied the stock market more than anything else, that also purports that you're probably going to have a prolonged, this looks to me more similar to the early stage, like in 2008, where it dropped October 2007 into around, June 2008. It was about a 20% decline. It stayed down, didn't recover quickly. It would have its little counter trend moves up, but they wouldn't quite hold, and they would fail and it would drift down to a lower low. And then you fast forward into, September 2008, you had the Lehman Brothers situation where they actually failed. And that was allegedly the cause of the waterfall decline that happened in October 2008. But so none of that may not happen this time around. But but it's just, to me, it's just fascinating to see how different people behave and respond to these things. But Jerry, I mean, I think Jerry probably would have something, the stocks part of it, has probably been, I think, one of the most interesting pressure points for CTA trend following.
Well, and of course, none of that was Mike predicting, even though it sounded like predicting. But I would just say that I don't just want to defend the idea of CTAs and trend followers trading stocks. And I don't think that there's pressure to add stocks. I mean, hardly no CTAs trade stocks, so they're not feeling pressure. And I didn't feel pressure to add stocks. I think it's a good idea to trade single stocks for the outlier possibility reasons versus an index. But there is pressure. I mean, I don't know if pressure is the right word, but when you get back to this original question that we had, I think it was from Marcus, and it was about what have we learned and what are we struggling with after 20 or 30 or 40 years of trading. I've always been a big believer in diversification and adding more markets. And when you get into the CTA business and everyone's only trading indexes, it doesn't take a lot of creativity to say, hey, why don't we trade single stocks instead? And because you could get more diversification. And so I didn't feel pressure to add stocks, but I've always tried to add markets for diversification purposes, to use those stocks for my own purposes to enhance the diversification. And recently, let's talk about the past year or two, there has been a tremendous amount of difference amongst the stocks. I try to put together a portfolio that 25 or 30% of my portfolio that's going to be long and short equities. That's a difference there as well, to maximize the diversification. So I'm seeking diversification. I'm going to tilt that portfolio to have a lot of different types of equities. And recently, the past year or two, it's been a huge success. I underperformed on the equity sector in 2021 because I had so many equities in my portfolio that were going down. And as the S&P went up, and indexes did a lot better than my group of equities, because I had on purpose tried to find stocks that were different and were not all the same. And I succeeded, unfortunately, because I didn't do very well in that sector, because I had, Beyond Meat, Canopy Growth, and they were tremendously different than some of the other stocks, but they were in big, huge downtrends. Now, 2020, you brought up 2020, and I agree with all of that, except that you can't leave out the fact about March of 2020 is that all the stocks crashed, of course. And so that's always going to be a possibility. So one of your first ideas or things you need to worry about when you set up your systematic approach is your total risk. It needs to be very conservative, and then your risk per sector, let's say. And so you don't want to trade mostly stocks, let's say, because you will have those periods where they kind of all crash. But 2020 was unique in a sense that everything crashed. I was long stocks, bonds, and commodities, and they all crashed. So there was no hiding from anywhere. There were no established short trends. So you can't just focus on stocks and trading too many stocks in 2020. I had too many commodities longs in 2020, and then they crashed. The bonds crashed. I don't remember FX, but there were just losses everywhere. And once again, so how are you going to protect yourself when everything you have on is losing? Ultimately, square one, which is my maximum risk budget. And then if that seems to be a bit much for 2020's price action, you'll have to exercise the money management rule of reducing your positions across the board in order to stem those losses.
And I want to say that I was thinking now about 2020 Corona crisis and other such things which we have seen. And I want to say that global macro guys, their main job is they are predicting different events. Maybe every day they predict something, and different prediction from different guys. And when some kind of event like Corona crisis 2020 occurs, they say it was unpredictable, and so like Neil said, remember that we are all conventionally wrong or unconventional wrong. So we are all in the same situation, and it's okay. But there is another approach, and a lot of people don't understand this. It's a trend following approach, a systematic approach, where it will be another performance.
Mike Shell, do you want to comment on what I said?
Yeah, I think. Well, yeah, I think that. Well, obviously, what I was alluding to, about adding stocks is that obviously, nobody is running the system that they started 30, 40 years ago. Everybody, there's a lot of work behind the scenes. I think a lot of, there's to me, it's interesting, and I probably need to write it out and maybe publish a paper or a book on it. But I'm kind of interested in, because we have lots of time on our hands, right, Jerry, to sit around and research and read and study, because we're not sitting. I like to look at charts a lot during the day, but I don't have to, so because I have systematized most everything I do. But
do the charts get wet when you're in the hot tub?
Yeah, they do sometimes. So. But yeah, and the fun thing is, normally I go and do my walk early in the morning and come back and get in the hot tub and for 30 minutes to an hour and check my emails and phone stuff. And the cool thing is, now with this iPhone 13 Pro Max is such a killer screen. I'm actually looking at charts on my phone for the last year for the first time ever, that you can actually legibly see. The apps haven't been that great until now, but this screen is something I can actually do that. But not in the hot tub this morning yet, because I'm running a little behind on doing my walk. But no, it's I think that we've talked about a lot of things over the last decade. Stocks. I think naturally, when the stock market is really rocking out, you're going to want to make sure you're getting enough exposure to those trends, and whether it's up or down. On the stock side of things, I think the upside is far more robust than the downside for trend. But it's but then the other thing was, of course, volatility trading, which is something I was a registered options principal at Raymond James early in my career, and I've traded options for over 2 decades, and I like to look and see, can I gain my exposure to a trend or whatever through constructing it with options. And, I think, and of course, VIX, for whatever reason, I've been following the VIX since probably the late 90s, when the first version came out and all that. Actually, the guy that started the VIX is was close, a couple of hours away from me. But anyway, the VIX is something I've always been very interested in, and I think that and I have a system that goes long volatility when it's cheap, and goes and could do the opposite when it's not cheap. And the beauty of applying volatility in terms of VIX kind of volatility, you can't really trade the VIX, but you probably know what I mean by that. By going, and Jerry and I have talked about that extensively over the last several years, is when volatility, the beauty of long volatility is volatility gets cheaper as everybody's complacent, and we've had that happen multiple times. We had it happen in 2018. In late 2018, the equity market was extremely complacent, and then there came the crash in December. So the nice thing about going long volatility is, if you do it when the premiums are really cheap relative to historical, so you're getting into, as a math guy, you got to enjoy getting into the to a lot of details of, looking at IV versus, implied volatility versus historical volatility, and then, what the implied volatility is relative to where it's been in the past. And, it's a kind of a relative value type situation. But I think that too has been a really, nice thing to focus on as well. But I think, for me, March 2020 was probably my worst drawdown, although it was about the same. I had my worst drawdown back in 2008. Throughout the entire year, I was down at 14.3%, and I'm talking daily high to low, not month end. Month end was only like 8% for the, but when I'm looking at the highest high my equity ever was to the lowest low it was at any given time, my true drawdown during that 2008 period was 14.3, and and it was completely intentional. Everything I did there in that time was what I planned to do, and it just, it is what it is. But in March 2020, I had a drawdown that was about that too, is around 15%. And the funny thing though is going into March 2020, and you could go back and look at my asymmetry observations from 2020 and read and probably get a sense for what I was thinking or maybe doing it during that time. But Asymmetry Observations is my blog, but in March 2020, going into March 2020, I was already reduced exposure, in some things because the trends become complacent and markets become tight, options premium becomes cheaper, and so I had already de-risked going into March 2020. I'd already been kind of de-risking, in my equity exposures. And then the funny thing though is, as I've done many times over and over again, I avoided that first, 12% drop of the stock index or stock market drop. I avoided that part of it, and then it reversed up for a couple of days, a few percent. And of course, trend following, jumping right back in, and then I participated in the latter part of that drawdown, and and it was a waterfall. I mean, it was like October 2008 where you had those waterfall declines, 3, 4, 5%, and and the thing is, by the way, in waterfall declines like that in March 2020, October 2008, October 2087, whatever. In waterfall declines, that's where options can pay off because there's so much convexity there at times. And nothing's ever perfect, but a big topic that I've been getting questioned a lot by other professionals right now is that year to date, and I just published a little short piece on this on Asymmetry Observations. This year, options have not been successful hedging the downside, generally speaking, because or like the put options. And Jerry, I've discussed that too. I mean, I remember we were talking about a 5 or 10% put option under the SPX, for example. Well, this year that has participated in every bit of the decline. And I posted CBOE has a 5% put option hedge index. PPUT is a symbol, and it's just an index, not a ETF or anything. But they have this hedging index, and it just basically buys every 30 days, buys put option. And this year it's down 20% along with the SPX. And a lot of people have been puzzled as to why that is. And really what it is options are heavily driven by volatility that you really want the prices to really spread out quickly. And if the prices don't spread out quickly, then the implied volatility doesn't expand as quickly. And so therefore, ultimately that impacts the price of the option. So this year, options have not been much of a hedge unless you are going long, VIX futures or long VIX options on futures or long, an ETF that has the VIX futures. those kind of things, is different. But this year, the options hedge has been unsuccessful, but trend following applied to the S&P has been successful, because you would have gotten out as it dropped and you're still sitting in cash, where in 2020, it was the opposite. The trend following didn't quite catch it as well, because you had a pretty good loss off the first stage. You'd have had some pretty good decline before you actually got out, and you're selling into some serious selling pressure. But in March 2020, though, the VIX, which means the premium on options, spiked. And so it's kind of, I think one thing that everybody should learn in the last 2 years is, if you're looking to hedge those kinds of risks, the option strategies are something I've always said to people. The option strategies are better for the crash, and trend is maybe better at other times. So that's kind of.
Sorry to interrupt you, Mike. I wanted to try to get some other people in, and before we have to go, anybody else have any comments or questions? I got a question on my messages from Andrew. Trend following club question: would anyone be willing to compare and contrast channel breakout system versus moving average crossovers, pluses and minuses? Well, I like breakouts. I think they keep you in the trade longer, and I think that's part of our psychology. We're looking to get out too quickly and book those profits. I like to take that to kind of an extreme, I guess, and sometimes it looks like I'm never going to get out. But I like the breakouts because they don't move up quite as fast and lock in profit. Of course, why would you not want to lock in profit? That sounds like something I would want to do. But I think when you do the back test, you can see that the breakouts perform pretty well the longer term, and they kind of keep you in. I think I've looked at moving average crossovers, and there probably isn't a great deal of difference. Oh, one of the things too is I kind of grew up on breakouts, and literally with the breakouts, buying the highs and selling the lows. And I think I noticed with these moving average crossovers that you can get a signal to go long or short, but it won't necessarily be at the high or the low. And I was like, no, I can't do that. That's, I like to think of myself as being open-minded, but I don't think I'm really, well, I might be in some situations, but when it comes to trend following, I definitely feel better actually buying that breakout high, selling that breakout low, because the moving averages, I think you can kind of sell after the market rallies or buy after it goes down. So that never sat well with me. So I'm kind of a breakout guy. Anybody else have anything they want to mention before we sign off?
Hey, Jerry Parker, just a quick question. I wonder, in terms of the volatility management, I wonder, did you have any, over the years, have you had any chance to get back to your mentors? I know that you've been around 40 years, so when I say your mentors, I meant to say, Richard Dennis, Bill Eckhart, or other people who you've been influenced and learned trading. Have you had any chance to get back to them and ask a question? What is their take, your mentors' take on volatility management? Thank you.
Well, that's a good question. I have not. Yeah, I'm pretty sure they would be, I would guess that they would be more accepting than I try to act like I'm not accepting of vol management. Of course, volatility sizing, everyone does that. It's not controversial. I think vol management, I think if I were to, when I've looked at it, we would take some of the position off as volatility increased, and our attitude was to be very kind of conservative in that we would do it in increments, and so maybe if we had a long-term trend up, we would, if the volatility doubled, we'd get rid of half the position and in that sort of vein. But we never thought about constant volatility management of a position, like you sell today, you buy tomorrow, and you just do it a trade almost every day. That I doubt is something that is very appealing. I've talked to other turtles and they said, oh yeah, we do volatility management, but only decreasing. So that's what I'm trying to get at. I could say, okay, decreasing. I think I've said before, I think some sort of position reduction based upon the volatility of the position getting totally out of control. I had that one trade where it was a bunch of years ago. The volatility was 10 times what it was when I put it on. So I think it's a big, huge profit. It's the volatility is totally out of control. And I think in a discretionary way, I would sort of say, yeah, I can definitely see how that's probably a pretty good idea to help you sleep at night and to reduce that position. I think that in outrageous situations, it's almost better to do it on a discretionary way, or it could be a rule, but honestly, maybe the sample size would be 10 or 20 over the entire look back period because it's just so rare. I think, ironically, I feel like that's better than a constant vol management of positions that has many, many trades historically that you could feel good about because we've done this back test. And so I think that I don't think is as good. And that people have accused me of, well, Jerry's in favor of discretion. Well, in this particular situation, I think that it's probably better just to have a rule that's going to be implemented or used on a rare occasion, because I don't think it's going to outperform just waiting for your medium to long-term exit to be hit. I've looked at that and I don't see that it makes more money over time, but it will. There is something to be said for being able to sleep at night and keeping your clients and things like that. I just think when you want to deviate from a very strict trend following approach, try not to do it very often. And you can, whether you define it as discretion or not, it kind of is discretion because the sample size is going to be fairly low. Sorry for that long-winded answer.
So Jerry, so what? So like when you do have a, I call it heat, the Ed Dakota thing. When you do have a lot of heat in a single position or whatever, or maybe your correlations of other markets, or a lot of times the return drivers drive in other markets too. But when you do have a lot of that, do you just raise your stop, or do you? Do you do anything like that as opposed to trying to manage? That's not necessarily managing the volatility; it's really managing the trend. I mean, because of a price that's spreading out a lot in the direction that you're positioned is a good thing. Do you ever like just raise your stop for protection, or maybe even stagger it to where there's to where you capture some of that, or do you ever do anything like that?
Well, I've looked at a lot of that type of stuff to try to systematize it. And, when I do things, I look at it and I compare it to the system exit, so the breakout exit. So I've got the one entry, the one exit, and I'm frequently see that I underperformed with this new rule. And that's why I don't like it. I keep looking at these trades and thinking if I would have used that other rule, I would have underperformed in general. I would have gotten lucky on some of the trades, but what happens is it's not symmetrical, because like that Tesla trade, it made 50 ATRs pretty quickly. It gave back the whole 50 ATRs, and then it went on to make 500 with more of those massive drawdowns. And so it would have been smoother, but you would not have made more money. on your Tesla. And so this is repeated in the back test over and over. That's why heavy vol management, when it's used, the traders that use it, they're going to measure their performance in terms of Sharpe or vol, not in absolute money made. So anyways, we're getting back into that again. So we don't want to do that. But anyways, I think the best thing to do, I've come to this conclusion that if you have this big profit and it's very large and it's very volatile and it's 10 times as volatile as when you put it on, then I think the best thing to do is just get out. Get out at the high. Just take the profits off the table. If you still can't sleep, then take a few more off and just realize that, yeah, a lot of people, like they're so invested in the vol management, and I'll say to them, like, well, you're taking smaller profits. You're not letting your profits run. That's what I'll say. And they'll say, I am letting them run. And I'm like, no, you're not. You got out. Well, yeah, I got out, but I'm letting the other profits run, whatever I have left, half the position, a quarter of the position. So it really is an emotional thing. And that's fine. But I do think all in all, if you can handle the pressure of these open trades and you got clients who are complaining, then maybe just take some off and don't even think about it and try to keep as much as you can. I don't think you'll make more money in the long run, but it's probably going to keep you more sane and more in business, if you know what I mean.
Yeah, and there's a lot of ways to do those things. I think that another consideration is to, speaking of options, is when a price trend has trended up sharply and gone up a lot and really spread out to the upside, or the implied volatility in that underlying is also done what? Well, it's declined, because when the price is trending up, most of the time the volatility is going down because people are really confident. So the trend really tightens up and people are so sure of it. When prices start to spread out, it's because there's indecision in the market, and a lot more people are battling back and forth trying to decide what to do. But when these killer trends are moving up, and they've been moving up for a while, say in Tesla, and the higher it goes, the lower the vol, generally, by and large, not all the time, but well, the beauty of that too is that if you go and look at a call option after it's already gone up a lot, your chances are your premium is going to be much less on that call option after the uptrend than it was, after, say, a downtrend. Okay, so something else, a person can do if they're constructing trades with, a wide range of things like ETF, stocks, options, futures, or whatever, is looking at a call option and saying, okay, could I get out of my other exposure here and let this option, play it out from here with a truly limited risk, because, you might sell $100 stock if you're long the actual stock, and only have maybe $5 in a call option from that point forward. And the beauty is, the market is providing that because, those options tend to be, the IV built into it tend to be less. So, there's all kinds of ways of doing stuff. And obviously that's kind of getting back to a little bit of the discretionary stuff. I always say that nobody's running the exact same system for decades and decades, and it's because we have to constantly look at our universe. And so just like when you were looking, the past 5-10 years, when CTA trend followers are looking more at adding stocks or even adding VIX futures and things like that, that's the smart thing to do. If you're a trend follower, you ought to always be looking, to me, part of the overall process is reviewing the universe in which we apply these signals. And so, you're constantly, like, I've got a lot of ETF trading I do. And so the universe is changing. There's new things coming out all the time. So, we have to spend a certain amount of time ongoing on looking at what's the universe of tradable things out here, and should this be included in here. So that's just all part of being robust too, is that not assuming that a fixed system should not ever be modified. And let me say one more thing, because something that's been interesting for me the last 10, 15 years, you have a lot of the academic type models out there, especially in the ETF world, where they called us tactical portfolio managers. In the ETF world became really popular about a decade ago. And what most of them are doing is they're just applying some really simple strategy, like, say the Meb Faber's 200-day moving average to 5 index ETFs kind of thing. And obviously there's a lot of missing parts there. That's more of an academic study paper. But the thing is, when they're just applying a trend following signal to, say, the 11 sector ETFs, you're only extrapolating an edge from just a trend following entry and exit. They're equally weighting them and all that. So there's a lot of things that are missing there, and I think that, but yet they'll still call it trend following, I think. But ultimately, I think you always have to be reviewing what the universe is, what's available to trade, and adjusting that part of it. Even if you use the same exact system applied to it, naturally, a trend following mindset wants to find trends. So you're kind of always looking for those next trends. So.
Marcus, let me just answer your question in a shorter way. You asked about what are we going to look back at in 10 years in terms of what we've learned. And I think you can really sum it up and say that actually it's a constant learning. Even though we've been doing it for more than 30 years, we are still learning. And I don't think that's going to change. What we will learn, we don't know. But I think the key thing is that we're going to hold on to the core concepts of trend following that we learned when we started, and the people coming into the industry now have the great advantage because there's so much information out there about what those core concepts are. There's so much more evidence of how they've worked. So I think that's the great thing. And I think the other thing is that we will always continue to be humbled by markets. So the fact that trend following is adaptive, the fact that we can make money in very different environments, I think that's the key thing. And so the key thing to look at right now is just to say the strategy has all the chances of continuing to work as well as it has done in the last 50 years. And we have a lot of evidence to prove that. So yeah, for me, it's just continuing to learn, but not knowing what it is we're going to be exposed to, and just observe the strategies, adapt along the way.
And in terms of that learning curve, just a quick question. I know that on the credit space, we can trade interest rates and bonds. I wonder, has anyone tried to trend follow instruments that are less publicly available to traders, such as total return swaps, CDSs, that sort of credit instruments? I wonder, has any of you tried this approach on your portfolios? Thank you.
I don't have any experience with that, but I know there are managers doing this. So yeah, I mean, it can be done. One thing I would always caution against is to again, what are the core concepts of trend following? One of them is we trade really liquid markets. So for me, I think it's problematic to, just because you can look at a chart or a backtest and you could see that CDSs have done really well if you applied certain rules, trend following rules, but if you don't have the liquidity you need at the time you need it, then these rules are not worth anything. And I think going away from liquid markets, unless you do it for a small portfolio where you can get in and out relatively easily, but for people managing other people's money, I actually talked about this with Alan this weekend. For me, I don't think our mandate is to take liquidity risk. I don't think that's what we are being paid for. We're being paid for applying and sticking to our trend following rules, but we're not being paid for taking silly liquidity risks that may end up blowing up our system, frankly. So I'm not a big fan of that.
Yes, Neil, I totally agree. But I just mentioned it because it's not publicly available to trend follow CDSs or total return swaps or interesting interest rate swaps. I'm not talking about mainly structured instruments where usually investment banks does, but there are many flow instruments where you may find liquidity without any problem actually on the credit space. And there are some bonds and there are some interesting bonds again not publicly available that you can find on interactive brokers. So, my hunch is they may trend better because there is not much. They are not yet publicly available, and many people are not actually applying these sort of approaches to trade them. That's my hunch, but I might be wrong, of course. Thank you.
I agree with Niels about the liquidity thing. And I also agree that trend following philosophy is that all the markets have the same expectation. And I mean, this is trend following philosophy. So the backtest will show that they don't. And I think the philosophy is it will in 100 years. They'll all have the same expectation. And I don't think I've heard this argument a lot, and I'm not going to fall on my sword for it, but I don't think that there's any, well, I know that a lot of smart people don't agree with this, but I think that I'm skeptical. Yeah, let me be a little bit more humble. I'm skeptical that markets that are less observed are going to trend better. I think that flies in the face of that they all have the same expectation. And also, it kind of is counter to the idea that we get these big trends because of endogenous factors. Something is going on inside of a market that is going to create this big trend. The news is going to come out very slow, and we're going to have a trend that lasts for a long time, a year or so or longer, let's say. And so it has nothing to do with how many people are trading it or it's not being observed very much. I know that a lot of CTAs, some CTAs who have made a big inroads, and I'm jealous of more what they call exotic markets. Let's say they're trading the China commodities for sure, which I can't and which I am jealous about. They will advocate that these markets are less mature, less followed by everybody, so they're going to trend better. That I'm skeptical about. I think that you should definitely add them to the portfolio and trade all of those markets. And the only thing better than trading 200 markets, which is what I do, is trading 300 or 400. And so for that reason, because you can get more outliers when you add more markets, I think that is the idea. But I don't think that there is enough data for one thing to prove, and this is kind of how I cheat all the time. You can just sort of dismiss creativity and good ideas just by saying, "Oh, there's not enough data." So I do that all the time, and I don't think there is enough to sort of declare that these less liquid or smaller or off the beaten track markets. I don't know. I made a lot of money randomly trading Tesla, Moderna, and some rather large stocks that had outlier moves. I mean, it was just that simple. I'm going to have to
Jerry,
go in just about 1 minute. So finish up, Mike.
Yep. Just a quick thing there. I think one thing I would look at is think about is, I think you need this underreaction and overreaction, the behavioral finance explanation of trend. So if you need underreaction and overreaction for trends to move, the problem with if there's not a whole lot of people in there, it could just go anywhere. I mean, I think your randomness is probably more likely as opposed to a trend moving in one direction because people are underreacting to information coming out. I think you kind of need more liquidity and more people involved is my first response or my first thought of it. So,
yeah, I would just say that I didn't mean to give the impression that, I think that what I'm saying is that the markets that I want to be in, like Neil says, they have sufficient liquidity. Okay. It's sufficient. There's not four people. It's not lumber. It's not milk. Okay. So let's get that off the table. Yes, they're all liquid. Now, does it matter if it's Microsoft and Google versus a China commodity that very few people are paying attention to, and that makes the China commodity better than Microsoft and Google? I don't think it does. I think you should trade Microsoft, Google, and the China commodities. They all have the same expectation. They're all going to have the same opportunity to have a big trend, let's say. Well, maybe not. Those were two bad choices for stocks, but certainly a stock that is less diversified. And I trade one stock that is the biggest egg producer in the country, and then I trade another one that produces the most amount of French fries. So that they have one business, and hopefully I'm going to pick up some sort of supply demand thing there with French fries and eggs. So I think they have the same expectation as the China commodities, but I want to trade them all, and they all have sufficient liquidity. Okay, it's been a great 2 hours, and hopefully you can hear me, and I'm holding my phone carefully. And we will pick it up again next week, same day, same time, and hope everybody has a good weekend. And I think we will have this as a recording. So everyone take care and see you next week.